Hello and welcome to episode 189 of the Money to the Masses podcast with your resident expert as always, Damien Fay and me, Andy Leaks. Damien, welcome back. How are you doing?
I'm good, Andy. I've been a bit of a hectic day. I've been up in London. Actually, at the moment, this is quite an interesting behind the scenes what goes on in Money to the Masses. Last week I was in Brighton. I was having meetings with the tech people behind the scenes of our wonderful website and about what we're going to do. But equally, I do go and see other firms. In particular, at the moment, I seem to be going through a spate of robo-advisors, going and looking under the bonnet of actually what's going on at these robo-advisors and grilling them over their propositions, how their investment process works, which is brilliant. No one else does it. I mean, you see some of the stuff out there, the journalistic stuff or whatever, it's very much high level based on their marketing. So I've been going to do that. So it means that I end up spending quite a lot of time going up and down to London. But it is interesting. It is interesting to dig underneath all this stuff. So I've not been doing much personally this week. It's just been sort of full on up to London, back again in time to put the kids to bed, then back up there again. And I mean, I live in southeast London, so when I say up in London, I'm just going into central London. But yeah, so it's been good, Andy. I'm enjoying it because getting your teeth into these things, it's interesting to see all these propositions because I'm not sure they really get what customers really are bothered about in that sort of circle. They always think that all customers are price sensitive, and it's not necessarily the case. Some of the nuances of what they do are more interesting and I think more important than the marketing bollocks basically they chuck out there, because they're all morphing into the same kind of thing. They're all converging really onto what their pricing, their minimum investments. They're all starting to look very, very similar. They started off very diverse and then they've all started to gravitate towards each other. So what's more interesting in is how they actually run your money rather than the bells and whistles on the products themselves. But yeah, sorry Andy, there was how's my week? I've just veered off into talking about robo-advisors, but interesting nonetheless, I'd like to think. But how is your week?
Yeah, it's been a good week, thanks. Yeah, last week I was obviously away. I was in a hotel doing bits and pieces. I'm back home, back on terra firma again, and not really been up to much since last time we chatted, because it hasn't been that long since we last chatted, really.
That's okay, Andy. You don't have to apologise. What has happened since the last time we spoke? We did finish the pod, as we often do, asking for reviews, and we had a nice review. Fantastic. It says EVP211. I do like the names of these iTunes users.
They sound like Star Wars characters, some of them, don't
they? They do. Maybe they are robos. Fantastic podcast with an exclamation mark. I had very little money savvy, but this podcast has really helped clearly explain things and increase my knowledge tenfold. Thank you, with a little smiley face. Tenfold, Andy. We need to try better. We could do better than tenfold. But that's a good review. I like it.
No, that is good. Good stuff. So if you would like to also hear yourself read out on the podcast, please do get online and give us a review. It really helps us to fly up those charts. Damien, on to the money stuff. What have we got on this week's pod?
This week I've got a piece about currencies. Now, this is an investment piece. When I'm not talking about your holiday money, I'm talking about currencies and a link to Jurassic Park. So just hold that thought. All will become clear shortly. I want to talk about SIP transfers. So pension transfers, basically. I get asked a lot of questions about pension transfers, and actually the number of transfers has doubled since 2014 in the sort of freedoms have come in, the pension freedoms that is. So lots of people are thinking about moving their money around, particularly their self-invested personal pensions. So I'm going to cover that, the reasons why you would and the risks involved. And then finally, I want to talk about lost luggage. I mean, it's very timely, but given that lots of people are going on holidays or returning from holidays without luggage. I want to cover the rules on that, because if you remember 2 years ago, I think it was,
we did a whole episode on
we did a whole episode that's very about my lost luggage, and there'll be many of you who didn't hear that episode, so I will briefly explain all. But it's really the rules around what happens. Who do you claim against? Is it your travel insurer or is it the airline? What are the rules? So I'm going to go over that.
Great. So what are we going to start with?
Right, let's start with the Jurassic Park currencies. Now, actually, before I do that, there was a quick aside I wanted to talk about. Last week we chatted about interest rates and the Bank of England hiking rates, and I was chatting about whether you should start thinking about fixing your mortgage. And if you are in that sort of indecision or that sort of trying to make up your mind what to do, now I mentioned that with interest rates going in the direction they are, i.e. up, that will start to be reflected in the Best Buy tables. And there's been some evidence, research, that's actually shown that's already occurred. Now, this is just to back up the point. Since January this year, we knew that there was, well, we didn't know, but the market was pricing in the idea that an interest rate would occur. They actually thought it'd be a bit earlier than it did occur. It occurred in August, but they thought it was going to happen maybe in June. So the market has already been thinking about that. So what mortgage lenders do, when they start putting out their products and their best rates, they start factoring in the idea that rates might be going up, because they're not going to give you a great deal if they don't have to. So just to prove that point, when you looked at the numbers, the Best Buy deals back in January versus where they were just before the rate rise last month, or actually this month because we're still in August, the rate rise from the Bank of England went up by 0.25%, but the Best Buy tables had already increased by around 0.18%. So let's just call it quits. The lenders had already factored in that rates were going up. So if you'd fixed in January, you'd be better off, is the point. So with our direction of travel being that rates are going to go up, the market will keep, generally speaking, it's more and more likely that the best deals will slowly start to disappear and the Best Buy tables will start inching up alongside market expectations of interest rates. But it was just interesting to see the actual evidence that is the case, because we talk about it anecdotally. Seeing the evidence is always good to pass on. Right, currencies. Now, we talk about equity markets quite a bit, and if you're an 80/20 investor, remember, I write a weekly newsletter every week, and I talk about different things in terms of what's going on in the market, what to look out for, the sort of insight and nuances that aren't brought out there by sort of journalists or anything else. It's really to give people insight so they can make their own decisions about things. And one of the topics I've picked up recently is about currencies. Now, if we look at markets where they are now, they are very reminiscent of where they were in January 2018, so the beginning of the year. And the reason that's relevant is because that was before the crash that we had in the spring. So just to remind people, in the spring of this year, equity markets fell by over 10% in developed markets, more so elsewhere in emerging markets, but they fell about 10%, which is called a correction. Bonds also went a bit haywire and fell, and have been a bit lackluster ever since. So that diversification that you normally get between bonds and equities kind of fell apart. So normally what happens, equities go up, bonds will tend to do the opposite. Not exactly, but they tend to. So they end up using them as diversifiers. So the flip side would happen when equity markets go down. It normally means people start to move towards things like bonds. Now, we talked about it at the time. What's interesting is that the market is looking quite like it did back in January 2018 before we had a crash. Now, the VIX is the fear index. I've talked about it before on the podcast, and it really is a measure of volatility on the S&P 500 in America, so the American stock market. But all you've got to think about, it's like a fear gauge, and that closed below 11, so the number 11, and that was the first time it did it since January. So January, everything was awesome. The whole world, you couldn't get any better. Markets were at all-time highs. Wherever you looked, records were being set. There was record levels of calm. It was just basically awesome. But then things took a slight turn for the worse. And we're back to that scenario again, where the markets crashed. We slowly started to recover. And it's taken quite a long time. It's not unusually long. It's been since February to August. So we're talking about 6 months. And normally the longer the sort of build up before you have a correction. So the longer the period of time without a correction, normally the longer the sort of correction phase takes to work its way out. So we've got to the point now that markets are pretty much, in America, was one of the last developed markets to really get back onto track. And now analysts are thinking, yeah, the worst is behind us. But I'm a great believer in that just because the market has moved on, you shouldn't. I think you should be mindful of what went on in the past, and I'll come on to that. Now, I said I was chatting to different robo advisors, and really they're investment guys, and I mean they agreed with my view that the market has got back to where it was previously, and it looks very reminiscent. And I want to pick up on currencies. And now, currencies are very volatile. So people trade currencies all the time against, like, so it might be the pound against the dollar, and you see all these sort of movements, and they're very volatile. But currency markets can be a bit of a canary in the coal mine. So they can be like an early warning indicator of something going on. And this is where my Jurassic Park reference comes in. Do you remember in Jurassic Park?
Good. I was waiting for where it was coming in. Good stuff.
You remember in Jurassic Park that scene where they're sitting in the truck
with I know what you say, with the water.
Yeah, that's it.
And it was with the vibration. You can see the ripple effect.
Yeah, and it was the one thing that everybody's seen this part of the film, but in case you're the only person in the world who hasn't, they're sitting in a car. There's a glass of water on the dashboard, and everything's
which
gone
is bizarre anyway. What was it doing there?
I don't. You've ruined it for me now, Andy, because now I'm gonna have to watch it again and wonder who put it down. Basically, what happened is that the water starts to vibrate. They're sitting there thinking what's going on, and it's a very sort of suspense. But then the water starts to vibrate, and I think is it Jeff Goldblum who looks at it? One of them looks at it, and it's vibrating. And it's what's happening is there's a T-Rex off camera that's slowly. Well, it's not slowly, it's trundling up to go and try and eat them. But the vibrations of its feet are first picked up in that water, and then it comes on, and then all hell breaks loose. Currency markets is what I'm trying to get at here. The analogy is that currency markets have an element of that because they're very sensitive to a lot of things that go on. They're very volatile. They bounce up and down. That they can be that early indicator of something bad coming along. I mean, in that scenario, it could be just the fact that it doesn't mean that they're always going to be an indicator. In that scene, it could have been someone just sort of rocked the car a bit, but. Doesn't mean that a T-Rex is going to come around the corner. But if we look back at January 2018 and we look at what's going on now in currency markets, there are some interesting similarities. Now, often in currency markets, there are relationships that happen. So we talked recently about in China, the Chinese stock market has been plummeting, and one indicator perhaps to look at has been fairly reliable is where their currency's headed against versus the dollar. So if you look at the Chinese currency versus the dollar, as that falls, is actually the stock market has fallen with it. It seems to be quite a good lead indicator at the moment. Equally, in the UK, when the pound falls, it tends to boost the FTSE 100. And that's because a lot of companies in the FTSE 100 make money in dollar terms from abroad. So that when they repatriate those earnings, if the pound has fallen, then those dollar earnings are worth more. So it makes their share price higher. So all you've got to worry about is tends to be an inverse relationship. So when the pound falls, the FTSE 100, the big companies tend to get a kicker. The opposite is also true. So when the pound rallies, it tends to be a drag on the FTSE 100. Now, in the last 3 months, that correlation has broken down, and that's very unusual. So what's happened, if you go and plot this chart, if you've got the time, just look at what the pound's done, look what the FTSE 100 has done. It's broken. It's not correlated anymore. They're just not doing anything. They're not even moving together or in opposite directions. Now, the last time that happened was in January 2018. And at the time I highlighted it because, this is to 80/20 investor members, because when things start to get strained and they start to break, that's when you sort of look at them and start to worry. So when things don't do what you think they're going to do, that's interesting and can be a warning sign. And at the time I said about this when I was writing, saying, look, this isn't a bit of a worry, but it doesn't necessarily mean that everything's going to go wrong. Well, actually, everything did go wrong, so I wasn't right on that point. But again, we are looking at markets, despite all the stuff that's going on in the background, that kind of wall of worry, all the sort of macro trends that are going on, and think reasons why we might be a little bit worried about markets being high, tech being almost a trade that's very crowded, lots of people pumping money into tech stocks, US stocks being overvalued, there's Donald Trump, he's a complete unknown, there's the trade war, all these things, there's similar things that are...
When you said Donald Trump is a complete, it isn't normally followed by the word unknown, it's normally a word that needs to be beat.
Yeah, I think that's why I went for unknown, but his behaviour is, you just can't quantify what's going to happen. So we're back there again, and it's worth highlighting that if you look at currency markets and you look at equity markets, they're telling slightly different stories. Equity markets are telling us everything is awesome. Currency markets are saying, not quite agreeing. And when we've had that in the past, it sometimes has been an omen for things to start to change. Now, this week, equally, we've had, when I started talking about this in 80/20 Investor, it was just about the time when we started to see some big moves in the Turkish lira. And we never talk about currencies like that, and we don't talk about the Russian ruble either. And both of those had some big moves. We're talking 20% moves in a day. And things like that start to eventually unsettle equity markets. Equity markets have held up relatively well, but when currencies start to do some crazy things, the equity desks and the equity investors start to have to take notice. And they're normally more sensitive, they normally are early on, but it just shows you that it's really just an FYI for investors to think they're in, like I talked about last week about the possible Brexit problems in the low risk end of your portfolio with property funds. Keep an eye on what currencies are doing for some wild moves out there. Keep an eye on what the yen is doing. Is the yen going up? If the yen goes up, it normally means the world is risk averse. Equally, funny enough, the Aussie dollar does the opposite. The Aussie dollar, when people get fearful, it tends to fall because of its exposure to commodities. So you see some of these things. The pound and the FTSE 100 aren't really behaving as they normally would. So it feels like some things are getting a little bit stretched and a little bit broken. And it pulls it all together, all of this together, and it comes back to the idea of things that are very similar to what they did in January. I'm a big fan of scenario testing. On a podcast, I can't remember which one it was, I started to talk about scenario testing. We've got into a scenario now that is very reminiscent of just before a crash that happened in February. So it is a very useful exercise to take your portfolio and look back at how it behaved in February. Because if we get a repeat, we might not necessarily get a repeat, because history doesn't often repeat, but it does often rhyme. And so you can test how your portfolio might work. And on that note, for people who do have 80/20 Investor, there is a stress test tool that I make, which I look at various different scenarios going back in history, whether it was a bond sell-off or a Chinese equity collapse. The various different scenarios I've done. Brexit, I think, was one of them. And there's a tool that shows how, gives funds a ranking on how they performed in those periods, so you can stress test them. And I'm going to update that soon to take into account what went on in January. Before we move on, Andy, I just wanted to quickly mention 80/20 Investor. Now, 80/20 Investor is my DIY investment service. Do go and check it out. I empower and teach people how to invest their own money. The service provides data-driven fund tables. The data is driven by my own unique 80/20 Investor algorithm, which I created. You also get stop-loss alerts, you get research articles and insights, you get market commentaries, monthly commentaries, and DIY investment lessons, but you also get access to my £50,000 portfolio, which is a portfolio of my own money, which I run live on the site for members to see, and it shows people how I use the service to maximise my returns. And in the first 2 years of doing so, I turned £50,000 into £59,500, which is a 19% return, beating investment managers, professional fund managers, financial advisors, investment banks, passive trackers in the market. So everybody can have a free 30-day trial of 80/20 Investor, and you can claim that by going to moneytothemasses.com and going and clicking on the 80/20 Investor hyperlink at the top of the page. So go and try the service. Let me know what you think of it, and I know from the feedback that you're going to love it. But for now, on with the show.
Okay, so we're talking about SIP transfers. What do we got?
Right, this piece has been inspired by the just general level of interest we see on Money to the Masses about SIPs and pensions. So a SIP is just a self-invested personal pension. So it gives you more control over what you're buying. To all intents and purposes, all you have to think about is a pension at the end of the day, but one that's a defined contribution. So you put money in, it goes into a pot. That pot grows depending on where you invest that money. And as the market has grown over time, we've got so many more products than we did have, say, sort of 8-10 years ago, that are far more cost effective and better value for money, that the market is really exploded. And as a result, people, in the early days, people went, oh, this is a self-invested personal pension. That means I could buy what I like. I can go and buy all these funds like I used to in my ISA or something similar. Because what used to happen, you'd have pension products that were linked to insurance companies, and you'd get 10 funds, and that was it. you get one equity income fund, one UK equity income fund or something, one European fund, a bond fund, and it was basically you got no choice. Then when SIPs came along, it was like, well, you can do what you like. You can invest in all sorts of thousands of funds from people outside of that insurance company. And of course, they had really big charges. While the range of investments improved, the price and cost became a bit of a stumbling block for some people. But that's improved. So there's now a hell of a lot of these products, these self-invested personal pensions. Just think pensions that are cost effective, that let you invest in pretty much what you want, that within reason. Now, with that greater choice becomes the question of, well, should I transfer my SIP or my pension to another provider? And now, since we've had the pension freedoms of 2014, which pretty much meant that you could access your pension as you wanted after age 55, there are people who had pots of money all over the place, maybe from past employers' schemes, or people who had defined benefit schemes or final salary schemes who wanted to go into a SIP and be able to access it. So they take a chunk of their money out and then they leave the rest in there and invest as they want. So there's been a massive increase. In fact, it's doubled since 2014.
Wow.
We're not talking about final salary pension transfers here. We're only focusing on people doing existing pension or SIP, defined contribution pensions. As a default, for final salary pension schemes, the regulator's default stance is you are better off staying where you are. So you almost have to prove that it's worth leaving. But always your default should be, nah, I'm okay where I am. Now, when it comes to looking at whether you should move your SIP, the one question I'm often asked is, can your SIP be transferred to another provider? Are there any restrictions? And the answer is, no, there's not, unless your provider has a penalty of some kind, so you can move it. And you don't have to have advice, so you could do it yourself. So you could go and look for another provider, and you may decide it's cheaper and you can move it. The only rules around having to have advice, if there was some form of guaranteed benefit of over £30,000 attached to your pension. Now, it's unlikely if it's a SIP because they're modern day products. And of course, if you do get advice, then advisors will charge a fee. But that's okay if you want to pay it, because if you're not sure about the products you're going to go to. Now, why would you want to move your SIP? Now, the first reason you would want to move your pensions or into a new SIP is because you might want to consolidate old pension products. You might have lots of little pots laying around. They may be slightly old style personal pensions, or they may be you've had a couple of different scheme pensions, some defined contribution pensions. Your existing product might be outdated or expensive. Now, there are SIPs that have been in existence, particularly from insurance companies, that now are looking dated and expensive, and there are far cheaper options out there. Cost-wise is very interesting. That's come down massively now. So the cost of a SIP, it used to be that the view was that unless you had over 100 grand plus maybe more, a SIP wasn't worth it. Now that's changed because the cost of running the SIP has plummeted so much that there isn't really a big barrier to entry. Now, there are going to be companies like Vanguard who will have a SIP very soon who charge peanuts for running money, and there are other companies out there who charge fixed fees for running their SIPs, so they're very low cost, and now the barriers have come down. And it's funny because I've gone over and looked at past content and things we talked about on Money to the Masses in its early days 8 years ago, and it was interesting to see that how things have changed and the market has moved on, because it was very much deemed about 8 years ago that if you had less than, or if you didn't have at least £50,000, investing really wasn't for you. And that has massively changed now. You can invest from as little as £1 with a lot of the robos. Whether you'd want to is a different matter. Getting back to the reasons why you might consolidate your pensions. Now, investment choice is a biggie. If you've only got a very limited range of funds, you've got a very limited range of outcomes. So if you want to maximise your returns or reduce risk or monitor or sort of manage risk, you can't do that if you've only got a very limited range of funds. And you might also want to transfer if you're perhaps moving overseas to an overseas scheme, but you really need to get advice if you want to do that. And you don't have to wait till a period of time to move your pension. You don't have to wait till you're near retirement. You don't have to wait till you're 55. You can do it now. So if it was me and I had a SIP or a pension, I would look to bring them all together, as long as there was no penalties, and try and manage them all together, because then you will hopefully save on cost, but then you'll be able to have a coherent strategy and look at them all in one place. Now, there are a few companies who do this. Pension Be one company that help with that consolidation process, but It's not really a SIP you get with them. Sometimes that word's bandied about quite a bit, but you get one of 4 trackers if you end up over there. But you can then move on into a SIP if you wanted to later. They're not going to penalise you. The risks of moving a pension are the exit penalties. Now, a lot of SIPs will have exit penalties. The platforms themselves will charge exit penalties, and they're applied often on a per fund basis. But by that I mean, if you had 10 funds, they might charge you £25 per fund that you move across. The way you can get around it is by consolidating the number of funds you have. I mean, Hargreaves are a company that do this. If you consolidate the number of funds you have, it reduces the number of charges that you're applied. I mean, the FCA are looking into this whole thing within the industry because they don't really like it. But the FCA don't move that quickly, so you're better off taking action yourself if you're going to move. Obviously, you could move into cash and then you move across a lump sum of cash. The only issue you have with that, obviously, is you're going to be out of the market while you're moving your money around. So if the market can move against you, so it could suddenly rally and you've missed out. And you end up buying back into the investments once you've completed the transfer at a higher rate. The one thing about pension transfers, I would say, there's no 7-day rule like you have with current accounts. Now, current accounts, you end up having a 7-day rule where it has to be completed. You can't incur any loss over direct debit not being carried across properly. So there isn't the similar rules yet with pension transfers, and I don't know why there isn't. And I think the regulators only just realised that is a hindrance to people moving around, because people don't move their pensions, and there's no reason why they shouldn't, because you could save yourself thousands of pounds a year in fees on your pension that is going to invest in exactly the same funds where you are now. So you could move from platform A to platform B and save yourself thousands. Compound that over time, that's going to be a huge impact on your retirement. One of the things to bear in mind, obviously, if you're near retirement and you decide to transfer, then that market can move against you and you might not have time to sort of make it back up. So bear that in mind. One of the answers is to look at if your outgoing platforms, the one you're moving from and the one you're going into, allow a in-specie transfer, like a re-registration. And what that does is basically move your funds across without you cashing them in. And there obviously will be costs to do it, but not all platforms do this because they got a bit frightened by a HMRC ruling about it. So I would always personally rather do that if that was me, because then you're not out of the market. The only danger is that you can take a while for the transfers to go through, so you can be stuck in limbo. If you're a long-term investor and you're not worried about making changes very imminently or trying to time the market, which we shouldn't really do, then you wouldn't be so worried about being stuck in the funds for a little bit of time while the transfer goes through. Obviously, got to check there's no guarantees under your existing plan that you're going to lose if you move. With a modern pension, it's unlikely. With some of the older style ones, there could be. So check that there aren't. On the exit fees, actually, I just forgot, there are some providers now that are starting to do offers that will pay, say, up to £500 of the exit fees that you would incur when you move to them from an old provider. Now, I think one of them is Fidelity, I think, does it. But then at the same time, Fidelity's platform, although one of the biggest, has had sort of teething issues with its technology. So we did do a review on it on Money to the Masses, so go and have a look, because I sort of go into warts and all on all of the platforms. So if you're going to look at a platform and you want to see if you're better off moving to a new one, have a look for our cheapest SIP article, so it compares costs. But then you can look at reviews of nearly every platform out there on moneytothemasses.com. It's a worthwhile exercise. On the note of if you do move, you can actually cancel. You do have typically a 30-day cancellation right. So you can move across and go, do you know what? I want to unwind that. There is an issue that the scheme you moved away from doesn't necessarily have to take the money back. So you can be caught in limbo, in which case you've got to find another home for the money. So just bear that in mind. So there are plenty of reasons why you would want to move SIP. That people do it all the time. It shouldn't be that cumbersome. It's much better now than it used to be. And there are reasons why you would or wouldn't do it. But just be mindful of charges and anything you may lose by moving. But be very clear about the charges you're going to be charged on your destination SIP.
Okay, so the last piece, we did a special on it a couple of years ago and it's reared its ugly head again. Lost luggage, what have we got, Damien?
Yeah, the rules on lost luggage. Now, timely, it's the summer, people go on holiday, and it's very personal to me because of my trip with my wife and I went to Barcelona while our luggage headed to Italy. And it was a very short trip and we pretty much never saw the luggage until about 2-3 weeks later. It just appeared at our doorstep back in the UK. But what happened is that obviously we had to go and buy some temporary stuff to clothes and things like that to wear. Otherwise, we would have had to wear the same clothes for about 4 days.
So just to clarify, because basically your luggage got lost on the way out there, so you were left in limbo in the place that you travelled to without any clothes, and it also hadn't arrived by the time you got home either.
No, it was still doing a tour of Europe.
Right.
Yeah, so it was a well-travelled suitcase, and yeah, of course we were there. And what do? You've got to go and buy yourself some clothes, otherwise I'll be walking around in the same things. For me personally, it probably wasn't a bad thing, needing an update in a wardrobe, given that what was in the suitcase. But it became a bit of a headache about how you claim for what happens. And I will be honest with you, I got so fed up with trying to battle with who was responsible, who would pay, with the airline, with our insurance, that once I got the luggage back, I just basically gave up on it. And they know we do that, and so that's a failing on my part. But there is a sort of an element where you just got to get on with life. The rules state that if that happens to you, the airline is obliged to offer money for the essentials that you have to buy to replace. And if you never get your luggage back, they have to replace what's in your bag. And of course, to do that, you have to have the receipts often, which is a pain, to show what the value of the things in there. And it's often capped at £1,000. Now, funnily enough, it's just reminding me of an incident that happened again in Barcelona. It must be Barcelona. I know it does have a problem with pickpocketing in Barcelona, but it does seem to have a problem with luggage as well. When we were once previously heading back from Barcelona, someone stole some clothes from our bag on the return leg from Barcelona to the UK, and we did claim against the airline in question and was successful, but we had to have receipts. But in this case, where we lost our baggage, the airline was a Spanish airline, and they were proving a complete pain. And what happens in this instance, we wanted to try and claim against our insurance, but the insurer said that you have to, we're waiting for what the airline would do. And the rules are, having looked them up now, the rules are that the airline is liable, and the insurer will typically have in state in their policy, they won't do anything until the airline has actually taken some form of action or refused to pay out. And now, of course, if they pay out and you deem it not enough, then you can make a claim against your insurer if the costs aren't fully covered. But often the insurer has a high excess, so your travel insurance will have a high excess, and they will have this wear and tear clause, and they might have to give you like low value in terms of lost luggage. So the short answer is, if you lose your luggage, or the airline does, they are liable to pay for things, but you're going to have to probably fight for an outcome before your travel insurance will even kick in and even listen to any form of claim or pay out. So it's going to be a headache, which you can understand why now. After the luggage, I got it back, I just gave up on the whole thing. But those are the rules. So bear that in mind if the worst should happen.
Good stuff, Damien. Enjoyed it this week as always. If you, the listener, would like to get in touch with Damien and have your question answered live on the pod, please do get in touch. It's at moneytothemasses with a number 2, or you can email Damien at moneytothemasses.com. If you've got any suggestions for the podcast, what you'd like us to cover, what you'd like us to improve, yeah, send it over. We're always happy to listen.
Yeah, on that, Andy, I would also like to, this might be a slightly bizarre request, but I'm also intrigued to get a feel from obviously female listeners who listen to this podcast about what they think about the show, because I've heard lots of criticism, or read something somewhere saying that the UK podcast space for finance was too male orientated and didn't do enough for women, which obviously I appreciate. I'm a man and I can't change that, but I would like to think that what we do is gender neutral. So if people don't think it is, then I'd be intrigued as to know why that is, because we want to include everybody, and obviously we do. Our topic is neutral, but it was something somebody actually said about a number of podcasts and criticised. Somebody said, "Oh no, there's not enough female podcasts," and even mentioned that ours was male orientated. But we can't help that. The content's not male orientated, but the fact is, Andy, we are men. But I'd like to hear generally from any females out there whether they feel that is the case, or if they any topics they would particularly like to hear covered.
Yeah, good. Well said. I suppose that's it for us this week. Until next week.
Until next week, Andy.
Don't forget to claim your free copy of Damien's best-selling book, The 30-Day Money Plan. Sort your finances in just 5 minutes a day, worth $4.99. Just go to moneytothemasses.com/podcast to find out how.